When it comes to the gift and the generation skipping transfer taxes, there's a little known exclusion that helps you avoid payment of these taxes for certain types of transfers, which constitute direct payments of health expenses or tuition expenses on behalf of a donee. Now, no degree of relationship is required with that donee. You can pay these expenses on anybody's behalf. However, only the amount that's not reimbursed by insurance or by a scholarship is eligible for this exclusion. And this can be leveraged in multiple ways, both for direct gifts during life or for certain distributions from trusts that might not be exempt from the generation skipping transfer tax or from the gift tax. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Welcome back to 10 Minutes with Griffin. For today's episode 171, we're going to dig into the health and education exclusion under Code Sections 2503E, which is an exclusion for gift tax purposes, and Code Section 2642C, which is an exclusion for generation skipping transfer tax purposes. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, you can email me to request a copy at griffin.bridgers@gmail.com. But on to the presentation. So the exclusion itself, set forth in Code Section 2503E, excludes direct payments of medical expenses and direct payments of tuition from the definition of gifts for gift tax purposes. Now, as you may recall from previous discussions on the generation skipping transfer tax, let's say you're making one of these payments on behalf of a grandchild or maybe a younger person who would meet the definition of a skip person for generation skipping transfer tax purposes. In that case, this type of transfer is also excluded from the generation skipping transfer tax, because Code Section 2642C gives this type of transfer an inclusion ratio of 0, meaning that there is a 0% generation skipping transfer tax rate. Now, there's many planning implications here and many ways you can take this, and a lot of them are pretty intuitive when you think about it. We'll touch on some that aren't at the end, but you must take special care to make sure you actually qualify for this exclusion, because ultimately, for one, this is applied before the annual exclusion, and it's a transfer that isn't reportable. You don't have to report this on a gift tax return. But because of that, you need to be really sure that you meet the requirements just in case there's an audit down the road. So, what is the direct payment exclusion? This is also known as the qualified transfer exclusion under the language of both code sections, but I'm going to use direct payment to describe the mechanics of this because you have to have a direct payment to the source. So, in the case of tuition, you have to pay directly to the educational institution. And in the case of medical expenses, you have to pay directly to the medical service provider. Or if you're paying medical insurance premiums, you have to pay those directly to the insurance company. So, long story short, this doesn't work if you allow the donee to be the intermediary. So what do I mean by that? Well, for example, let's say your child is heading off to college and you put some money into their account to allow them to pay tuition. Now, even if they use that money to pay tuition, that's not a direct payment and you wouldn't get this gift tax exclusion. However, if you just wrote out a check payable to the bursar's office at the college and gave that to your child and told them, hey, get this paid with this check when you get down there, you can't put this in your account because it's not payable to you, then that would probably be okay. Or nowadays, nobody uses paper checks, nobody uses the bursar's office. You'd probably just pay that directly to the school through an online portal. In that case, that would be okay as well. But anything where the donee receives the funds and can control those first would not meet this exception. So, with educational expenses, there are some nuances to this that you need to be aware of, in that they only include tuition for the education or training of the donee themselves. So, for example, if you're paying this expense on behalf of a parent, it's not an excluded gift on behalf of the parent, it can only be an excluded gift on behalf of the individual donee, in that case the parent's child, who is receiving the education or training. Now you have to pay this to a qualifying educational institution that's described in Code Section 170. Now, just because it's described there doesn't mean that the institution itself has to be tax exempt. It just has to meet the requirements of what's described under that code section. But there are some specific requirements that do kick in, that you have to have a regular faculty and curriculum at the educational institution, and you have to have a regularly enrolled body of students or pupils. Now, you're not limited to any specific course of study. This could be for K through 12 education, could be for any sort of degree-seeking program, bachelor, graduate, whatever the case might be. It could even be for professional training and certificate programs that don't result in any sort of baccalaureate degree. But when it comes to this, you're just looking at direct tuition. This exclusion won't include any amount you pay for things like books, supplies, dormitory fees, board, meal plans, or even similar expenses. So you have to look at the tuition element only if you're going to plan for making this type of transfer. Now, when it comes to medical expenses, we can't really go into the full details of what this includes because, by reference, this refers to Code Section 213D, which deals with the income tax exclusion you can get for out-of-pocket medical expenses in excess of 10% of your AGI in a year. Now, that income tax definition, other than the definition, that income tax element isn't relevant to the gift tax exclusion. You get this for every dollar of medical expense paid, unlike the income tax deduction. But when we break down that definition, this is generally going to include anything that relates to the diagnosis, cure, mitigation, treatment, or prevention of a disease, or anything affecting any structure of the body or transportation to receive medical care. This can also include amounts paid for medical insurance premiums, but it doesn't include any expenses that are ultimately reimbursed by that medical insurance. Now, there's a couple other things to call out from Code Section 213D, that this can include lodging away from home as long as it's primary and incidental to that medical care. So if you're turning it into a mini vacation, that's not going to count. But if the lodging is right by the hospital and really just intended to, be a necessary part of that medical care, then you're covered. Same thing would apply in the case of cosmetic surgery. If it's elective, really, you're not going to get this exclusion. But if it's necessary, for example, to correct a deformity that is related to a congenital abnormality or relating to an accidental or traumatic personal injury or disfiguring disease, then cosmetic surgery could be covered under this sort of exclusion. So once we have that exclusion, like I said, it's kind of intuitive as to how you can apply this. This is a great way to reduce down or spend down the value of your estate to avoid estate tax, but without having to actually incur any gift tax for that transfer. But let's say you already have trusts set up, or you plan to set up trusts instead of making these types of direct payments. In that case, in some scenarios, you could probably use these exclusions in a trust scenario. For one, on the gift tax side, most of the time, when you create an irrevocable trust, you're going to have a gift to that trust. So once a gift tax has been applied, it's too late to apply this. So you can't really use this for the funding of a trust. But if it's a revocable trust or an irrevocable but incomplete gift trust, such that the gift tax is applied at the time that a distribution is made, then you might be able to leverage this exclusion for trust distributions. Similarly, for the generation skipping transfer tax, there are some other requirements to this to be covered in a later discussion, a later episode, but leveraged right, you can also use this exclusion to take a trust that's not exempt from the GST tax and look at that and look at how this applies to distributions to beneficiaries who are skip persons. Now, traditionally, those types of distributions would be treated as direct or either direct skips or taxable distributions, which would be subject to the GST tax. But in the case of this exclusion, If the distributions are in the nature of direct payments for medical or tuition expenses, then you could avoid the GST tax on those distributions. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.